Hello guys, welcome to Koi Academy, and in this video we'll be talking about a very important concept in financial management, and that is the difference between bear and bull markets. So we will be discussing the differences from various angles. First of all, talking about the meaning, a bull market is a period when the prices of the shares tend to rise, whereas in a bear market the prices of the shares tend to fall considerably. So this is the basic difference. That is, in a bullish market the prices tend to rise, whereas in a bearish market the prices tend to fall. Talking about investor sentiments, in a bull market investors are optimistic. That is, investors believe that the share prices are going to increase in the future. Let's suppose a share is trading at $10 today. Investors will believe that this share will rise to, for example, $20 in the future. So investors are optimistic about the market in general and share prices in particular. Whereas in a bearish market, investors are pessimistic. They believe that the share prices will decrease. Talking about the position which the investors take in a bullish market or in a bull market, it involves buying of stocks in large volumes. This is because investors believe that in the future the prices of the shares will increase. So if a share is currently trading at $10, investors will want to buy more of it because they believe that in the future the share price might rise to $20. So they will make a profit of $10 in the meanwhile. Whereas in a bearish market, there is considerable amount of selling of the stocks because investors believe that share prices will fall. For example, if the share is today trading at $10 and investors expect that it might fall to $5, then what investors will do is that they will sell their share for $10 today in order to avoid that $5 loss which will happen because the share price will fall. So yes, investors sell their stocks in bearish market to avoid the losses. Prices of the stocks, well, in a bull market stock prices continue to rise, whereas in bearish market stock prices continue to fall. Trading activity in the bullish market is high because more and more investors want to buy more and more shares because they believe that in the future the prices of the shares will increase and they will make a healthy profit. Whereas in a bearish market the trading activity is low. People do not want to buy the shares. Demand is low. Instead the supply of the shares is high because more and more people are selling. Market indicators: in a bull market investors are willing to take part in order to make a profit. That is, they want to buy shares, they want to take part in the market. Whereas in bearish market they want to get out of the market, they want to sell their shares and get out of the market to avoid further losses. Economic situation in a bullish market, well, bullish markets usually exist in an economy which is strong or which is strengthening, because overall if the economy is strong and growing, the demand for the products increases, which means that companies will have to produce more, and once the companies produce and sell more, it means that their share prices will increase. So yes, bull markets are generally located in strong economies, and bearish market, well, they are generally located in weak economies. Talking about GDP growth, bull markets are in countries usually where the GDP is rising, and bearish market are in countries where the GDP is falling. So that's it for the difference between bull and bear markets. If you like the video, don't forget to subscribe, and in order to view videos on other concepts on accounting, finance, marketing, management, etc., do subscribe and search the playlist. Thank you.